Navigating the investing maze can feel like a dense, impenetrable jungle. You're bombarded with complex charts that look like spaghetti. Jargon flies around like angry hornets, ETFs, PE ratios, bullish, bearish. What does it all mean? You hear about surefire tips from your brother-in-law or some guy on the internet. It's overwhelming, to say the least. You feel like a fish out of water, gasping for air, wondering if you'll ever understand it. You just want to make your money work for you, to build a secure future. But it often feels like you need a secret decoder ring just to get started. This widespread confusion is a major roadblock for so many good, hardworking people. This complexity isn't an accident, folks. It often feels intentionally designed to keep you out, to make you feel like you don't belong. We're here today to cut through that dense fog of confusion and show you there's a better, more understandable way to build lasting wealth. Now, let's tackle a giant myth head-on, one that has held too many people back for too long. It's the pervasive idea that screams from the rooftops: investing is only for the experts. You've heard it whispered, you've seen it implied, haven't you? That you need to be some kind of Wall Street wizard, a financial guru with mystical insights to have any realistic chance of success in the market. Folks, let me be crystal clear, that is a flat-out lie. It's a carefully crafted narrative, often designed to make you feel inadequate and dependent. They want you to believe you're not smart enough, not savvy enough to manage your own money effectively. But take a moment and think about your own life. You manage a household budget, often juggling multiple financial priorities. You make critical decisions for your family's well-being every single day. You navigate complex situations at work with skill and competence. You absolutely have what it takes. So, who truly benefits from perpetuating this experts-only illusion? It's often the very industry that positions itself as your sole source of help. By making investing seem incredibly complicated and inaccessible, they create a persistent demand for their expensive services and advice. So, who exactly is this Peter Lynch we keep mentioning? He wasn't some mystical Wall Street figure shrouded in layers of secrecy and complex financial theories. He was the highly respected and remarkably successful manager of the Fidelity Magellan Fund, a position he held from 1977 all the way through 1990. During his impressive 13-year tenure at the helm, the fund achieved an average annual return of an incredible 29.2%. To put that into perspective, that's more than double the performance of the S&P 500 index over that very same period. How did he manage to achieve such consistently phenomenal results, outperforming the vast majority of his peers? It wasn't by chasing complicated investment theories or relying on mysterious black box algorithms. Lynch's particular genius, his edge, lay in his profoundly simple yet powerful philosophy: invest in what you know. The absolute core of Peter Lynch's renowned investment strategy is beautifully, refreshingly straightforward. He held a strong conviction that the very best investment ideas are often hiding in plain sight, right before our eyes. They're not typically buried deep within obscure, lengthy financial reports or whispered among elite Wall Street circles. Instead, they're right there, embedded in your daily life, waiting to be noticed. Think about the local coffee shop you visit every morning that consistently has a line stretching out the door, regardless of the weather. Consider the particular brand of sneakers your children and all their friends are suddenly raving about and desperate to own. Let's be honest, folks. Have you ever looked at a stock chart and felt like you were trying to read ancient hieroglyphics? All those squiggly lines, the candlesticks, the moving averages, it's enough to make your head spin right off your shoulders. Then there's the language. Words like quantitative easing, derivatives, EBITDA, and arbitrage get thrown around like confetti at a Wall Street parade. It feels like they've invented an entirely separate language, a secret code designed specifically to keep ordinary, hardworking people like you and me feeling lost and confused. This isn't just a minor hurdle, it's a massive wall that stops many folks dead in their tracks before they even consider investing their first dollar. It's designed to make you think this whole investing thing is just too tough for you. But let me ask you a question. Who really profits when investing seems impossibly complex? Who benefits when you feel like you need a special interpreter just to understand the basic rules of the game? Well, it's often the very same people who are selling those complex financial products and services. When things are confusing, you're much more likely to believe you need to pay someone a hefty fee to manage your money for you. They create a fog of complexity, and then they sell you the expensive flashlight. It's a clever system, isn't it? This jargon jungle isn't an accident. It's often a carefully constructed barrier. It's a way to maintain control and keep you feeling dependent on their supposed expertise. Section 2. The Expert Gatekeepers. Why they want you to feel small. Building on that idea of unnecessary complexity, let's talk about the expert gatekeepers. You know who I'm talking about. The financial advisors in sharp suits, the talking heads on television, the analysts who speak with such authority you'd think they have a crystal ball. There's a powerful narrative out there that insists you hand over your financial destiny to these proclaimed experts. It's a message that whispers and sometimes shouts that you're not qualified to make your own investment decisions. That, without their guidance, you're just wandering lost in a dangerous financial wilderness, destined to fail. This myth is incredibly effective at making people feel small, inadequate, and completely out of their depth. Think about the image they project, the fancy offices, the complex software, the air of knowing things you don't. It's all part of the show, designed to reinforce their status as the indispensable navigators of the financial seas. And yes, some advisors are genuinely helpful, but the system itself often encourages you to feel dependent. Section 3. The hot tip mirage, chasing ghosts and empty promises. The allure of the hot tip is a dangerous myth. You hear it from your colleague, your brother-in-law, or an anonymous guru online. Psst, I've got a stock that's about to take off, you gotta get in now. It's so tempting, isn't it? The idea of a shortcut to riches, a secret piece of information that will let you bypass all the hard work and research. We all want to believe there's an easy button for financial success. This desire for a quick win makes people incredibly vulnerable to these whispered promises of instant wealth. But what usually happens when you chase these so-called hot tips? More often than not, you end up losing money. Think about it. If a tip is truly that hot and widely known, the big players, the institutional investors with their supercomputers and armies of analysts, have likely already acted on it. By the time it reaches you, the opportunity has often passed, or worse, it was never a good opportunity to begin with. Investing based on hearsay, without understanding the underlying company or its business, is like gambling. You're betting on a rumor, not on a solid foundation. It's a recipe for anxiety and, frequently, financial disappointment. Then there are the gurus and online influencers who pop up, promising to share their secret formula for beating the market, usually for a hefty subscription fee, of course. They flash images of lavish lifestyles, implying that you too can achieve this if you just follow their advice. But how many of these gurus have a verifiable, long-term track record of success that stands up to scrutiny? Many are simply skilled marketers, preying on people's hopes and fears. They promote a constant churn of next big things, encouraging frequent trading, which often benefits the broker more than the investor. True financial success is rarely built on fleeting fads or the pronouncements of self-proclaimed wizards. The emotional toll of constantly chasing these hot tips and following flawed advice can be devastating. You experience a roller coaster of hope and despair. You buy on a tip, watch the stock plummet, and then sell in a panic, locking in your losses. Frustration builds. You start to feel like the market is rigged against you. Peter Lynch offered a completely different path. His approach wasn't about chasing shiny objects or relying on whispers. It was about diligent, patient investigation of businesses you can understand. It was about substance over sizzle, research over rumor. This is the sane, steady path to building real wealth, not the frantic chase after elusive mirages. Section 1, the Oracle of Omaha? No, the Observer of the Everyday. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, delivering an average annual return of 29.2%. His secret? Simple, relatable investing. Lynch's core message: invest in what you know. This approach made investing accessible and successful for many. Let's explore how you can apply this wisdom to your own investment journey. Section 2, invest in what you know, the Lynchian Golden Rule. Peter Lynch's principle: invest in what you know. Focus on companies whose products you understand and use. If you can't explain a company to a fifth grader, avoid it. This principle filters complex businesses, focusing on your strengths. Play on your home turf for a natural advantage. As a consumer, you spot trends early. Observe what's popular locally. Notice long lines at restaurants. See what gadgets kids love. This frontline experience offers early signals. Be an astute observer of the world. Contrast this with Wall Street analysts. Lynch valued amateur intelligence. He found investment ideas from family. Local knowledge is key. Investigate compelling local leads. This local knowledge is indispensable. Invest in what you know is a starting point. It helps identify potential candidates. Don't blindly invest in favorites. Do thorough research. This filter makes research manageable. Focus on businesses you understand. Section 3, your daily life, an uncharted territory of 10-baggers. Peter Lynch taught that your everyday life can transform into a fertile investment research laboratory. Your regular trips to the grocery store, the countless brands you see advertised, the various services you use, and even casual conversations, all can serve as sources of investment ideas. Lynch encouraged curiosity, to ask questions about the world around you. Why is this brand of yogurt flying off the shelves? Why is that boutique gym always packed? This curiosity can transform daily activities into opportunities for discovering 10-baggers. A 10-bagger is an investment that multiplies its value tenfold or more. Section 4. Beyond popularity, understanding the company's story. Popularity alone isn't enough for investment. Peter Lynch sought enduring companies behind successful products. Understand the company's story, its mission, values, revenue model, and competitive advantage. This helps assess future growth and profitability beyond temporary success. A compelling story provides context for financial analysis. If the story doesn't make sense, financials might be misleading. Lynch believed understanding the story helps recognize changes early. Peter Lynch's investment strategy begins with a vital and empowering step: becoming an investor detective. This means using your everyday observations and experiences as the starting point for uncovering potential investment opportunities. It's about transforming the mundane into a goldmine of insights. Every trip to the mall, every product you pick up, and every service you use could be a clue. Lynch taught us that the best investment ideas often come from what you already know and trust. The objective here is to be observant, curious, and always on the lookout for trends in your daily life that could translate into profitable investments. Start by paying close attention to the products and services you use regularly. Is there a new coffee shop in town that's always packed? Did a particular app suddenly become a must-have among your friends? These are the kinds of observations that Lynch valued. For example, if you've noticed that more people are using a certain brand of fitness tracker, this could be an indication of a growing trend. The key is to recognize these patterns and then ask yourself why this product or service is gaining popularity. Is it solving a problem that others have ignored? Does it offer better value or quality compared to its competitors? Once you've identified a potential investment idea, it's crucial to start gathering more information. This involves not just passive observation but active inquiry. Talk to employees or managers about the product's popularity. Read reviews online and see what customers are saying. Are the reviews generally positive? Are people enthusiastic about recommending the product to others? This kind of grassroots research can provide invaluable insights that aren't immediately apparent from financial statements or analyst reports. It's about getting a real-world perspective on the company's products and brand. Lynch often found investment ideas through his family and friends. They would mention products or stores they loved, and he would take a closer look. You can do the same. Ask your family and friends what new products or services they are excited about. What brands are they talking about? What stores do they frequent? Engaging in these conversations can help you spot trends early and get a sense of what might be the next big thing. Remember, being an investor detective is about using your unique vantage point as a consumer to identify investment opportunities that might not yet be on Wall Street's radar. After identifying a potential investment, the next step in Peter Lynch's approach is conducting household research. Understand the basics of the company and its industry. Know what you're investing in. Understand the company's business model and market. Ask simple questions. What does the company do? How does it make money? Use the internet for initial research. Look up the company's website and read about its history, mission, and products. Check out recent news articles to see if the company has been in the headlines and why. Look at customer reviews and testimonials. Are people generally satisfied with the company's products or services? Are there any recurring complaints or issues? This kind of qualitative research helps you form a basic understanding of the company before you delve into the numbers. Next, move on to financial websites like FinViz, Yahoo Finance, or Seeking Alpha. These platforms provide a wealth of information in a user-friendly format. Start with the basics. Look at the company's revenue and profit trends. Is the company growing? What about its profit margins? Check its debt levels. A company with a lot of debt might be risky, especially if it's not generating enough cash to service that debt. These sites also provide valuable metrics like the price-to-earnings (PE) ratio, which can help you gauge whether the company is reasonably valued compared to its peers. Peter Lynch outlines specific characteristics of an ideal company in his book. Look for companies with strong competitive advantages, often referred to as moats. These could be brand strength, patent protection, high customer loyalty, or cost advantages. For example, a company like Coca-Cola has a powerful brand and a vast distribution network that new competitors would find hard to replicate. Also, consider whether the company is in a growing industry. A company with a strong market position in a stagnant or declining industry might struggle to deliver long-term growth. Finally, assess the company's management. Good leadership is crucial for a company's success. Look at the background of the CEO and other key executives. Have they been with the company for a long time? Do they have a track record of success in the industry? Read the company's annual reports, especially the letters from the CEO. These can provide insights into the management's vision and strategy for the future. Are they focused on sustainable growth, or are they chasing short-term gains? Conducting thorough household research helps you build a solid foundation of understanding, which is essential before making any investment decision. One of Peter Lynch's most important lessons is the value of patience in investing. He wasn't a day trader, he believed in the power of compound growth. Practicing patience means holding on to your investments for the long haul. Lynch famously said, "The real key to making money in stocks is not to get scared out of them. This means sticking with your investments even when the market is volatile." Consider the story of Amazon. In its early days, Amazon was primarily an online bookstore. Many investors were skeptical of its long-term success. However, those who believed in Jeff Bezos' vision and held on to their shares were richly rewarded. Amazon didn't become a trillion-dollar company overnight. It took years of reinvestment, innovation, and strategic expansion. If you had sold your shares during one of the many downturns, you would have missed out on extraordinary gains. Patience also means resisting the urge to constantly check your stock prices or react to every piece of news. The stock market is inherently volatile in the short term, with prices fluctuating based on rumors, economic data, and investor sentiment. These short-term movements can be stressful and lead to impulsive decisions. Peter Lynch advised focusing on the long-term story of the company instead of getting caught up in daily price movements. Look at the company's progress over quarters and years, not days and weeks. Moreover, practicing patience involves understanding the power of compound interest. Albert Einstein famously called compound interest the eighth wonder of the world. The idea is that the returns you earn on your investments can themselves earn returns over time, creating a snowball effect. For example, if you invest $10,000 at an annual return of 10%, after 1 year, you'll have $11,000. The next year, you'll earn 10% not just on your original $10,000, but on the $11,000, resulting in $12,100 and so on. Over decades, this compounding effect can lead to substantial growth, reinforcing the importance of a long-term perspective. Finally, patience requires emotional discipline. The stock market will test your resolve with periods of high volatility and economic uncertainty. There will be times when your investments underperform, and you might be tempted to sell in a panic. However, if you've done your homework and believe in the long-term prospects of the companies you've invested in, it's crucial to stay the course. Lynch's success was built on the principle of holding strong, fundamentally sound companies through thick and thin, allowing them the necessary time to grow and deliver outstanding returns. Section 4. Mastering the art of selling. Knowing when to sell is crucial. Peter Lynch emphasized selling based on logical criteria, not emotions. Sell if the company's fundamentals change or if it takes on excessive debt. Regularly review your portfolio to align with your financial goals. Mastering selling involves understanding fundamentals, industry trends, and portfolio alignment. Section 5. Applying Lynch's lessons to your portfolio. Apply Peter Lynch's investment strategy to your portfolio by creating a watch list of companies you understand and researching their fundamentals. Diversify your investments, monitor performance, and stay informed about industry trends. Rebalance your portfolio regularly to maintain your desired asset allocation. With discipline and patience, you can build a robust, diversified portfolio for long-term success. Section 1. The investor's inner battlefield. Fear, greed, and frustration. Investing stirs a potent cocktail of emotions. Fear, greed, and frustration are universal, testing both seasoned pros and beginners. Understanding this inner battlefield is crucial for success. Fear paralyzes, greed blinds, and frustration crushes. Recognizing these emotional enemies is your first line of defense. Section 2. Weathering the market storms, the emotional anchor of knowing. Remember John, our everyday engineer, lost in the chaotic sea of tips and complex charts? His initial foray into investing was a textbook case of emotional turmoil. He rode the highs of fleeting gains with euphoric excitement, only to be plunged into the depths of despair when his poorly understood investments inevitably cratered. The shame of losing money, the anxiety about his family's future, the constant second-guessing, these feelings consumed him. He felt trapped, like a victim of a system he couldn't comprehend, let alone master. This emotional roller coaster is exhausting, and it's a place where so many aspiring investors find themselves before they discover a more grounded approach, a more stable anchor in the storm. But then John discovered Peter Lynch's philosophy, and something profound began to shift, not just in his portfolio, but in his very emotional state. The core principle, invest in what you know, acted as an immediate balm to his frayed nerves. Instead of chasing abstract financial instruments or companies whose business models were a complete mystery, he started looking at the world around him, the software his company used, the brands his family loved, the services his community relied upon. This simple shift brought an incredible sense of clarity and comfort. Understanding the actual business, the real-world product or service, demystified the investment process. It was no longer about gambling on cryptic symbols. It was about partnering with tangible, understandable enterprises. This newfound emotional stability was further solidified by Lynch's emphasis on deep household research. Once John identified a company he understood from his daily life, he didn't just blindly buy the stock. He dug in. He learned about its financial health, its competitive advantages, its management, its story. This process of diligent investigation built genuine conviction. When you truly understand why you've invested in a particular company, when you believe in its long-term prospects based on solid research rather than a hot tip, you become far less susceptible to the market's daily mood swings. The inevitable dips and corrections are seen not as disasters, but as potential opportunities or simply as noise if the company's core story remains intact. This conviction is a powerful emotional shield. And finally, Lynch's insistence on patience provided the ultimate emotional regulator for John. The stock market is a notoriously impatient place in the short term, but it often rewards those who can play the long game. By focusing on holding quality companies for years, even decades, John learned to detach from the daily drama of price fluctuations. He understood that building real wealth is a marathon, not a sprint. This long-term perspective helped to smooth out the emotional bumps along the road. The anxiety of needing to time the market perfectly faded away. He knew his well-researched companies needed time to grow, and he was prepared to give it to them, cultivating a sense of calm he'd never experienced in his earlier investing days. Section 3. From Anxiety to Assurance. The True Peace of Mind Investing. Embracing Peter Lynch's common-sense approach transforms an investor's emotional landscape. Shift from reactive to proactive, making deliberate choices based on diligent research. This transition brings empowerment and control. You become an active, informed participant. Trust your judgment, rooted in solid homework. This confidence is a game-changer for your well-being. Investing becomes a thoughtful, deliberate process. Achieve financial peace of mind. Section 1. The Lynch Blueprint. From everyday observations to empowered investing. Peter Lynch's philosophy is simple. You don't need a Wall Street pedigree to succeed in the stock market. Your everyday experiences and observations are your greatest assets. By paying attention to the world around you, you can identify promising companies and make informed investment decisions. This approach demystifies the market and empowers you to take control of your financial future. Embrace Lynch's strategies and transform your investing journey from confusion to confidence. Begin to consciously observe your surroundings with the mindset of an investor. Notice the brands your family trusts, bustling local restaurants, and innovative software solutions. Identify companies solving problems and providing value. Your daily life is a tapestry of economic activity, offering clues to strong investments. Conduct thorough research to understand a company's financial health and competitive position. Apply Peter Lynch's principles for lasting success. Transforming your financial future is a journey of learning and patience. Adopt a sound investment strategy grounded in common sense, research, and a long-term perspective. Buy a company, not just a stock. Observe the world with new eyes, learn continuously, and take control of your financial destiny. The essential tools and knowledge are now in your hands.